I call it my Cortez moment. So when Cortez got to America, or actually Mexico, I think it was, he basically gave the first order that he gave to his men when they came ashore was to go and burn the boats, indicating to them that there was no way back and that you've got to make it work here. And so what I did was I took my software, which was really fast and some of the best in the industry in TradFi, high frequency, and I sold it, which was nice. And that was my Cortez moment of saying, I'm not going back.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show.
Sam, thank you so much for joining me today. Super excited to chat with you. All right, Sam, you are the Chief Investment Officer of the Directional Fund at Monarq Asset Management. Monarq is a quantitative and systematic multi-strategy digital asset investment firm. Previously, you were a portfolio manager at Block Tower Capital. You're a founder, CEO, CIO of multiple trading firms, and the CIO of the self-regulatory organization FINRA. All right, so Sam, just off camera here, we were talking about your very early career, where you started off trading in the commodities pits in New York. Can you tell me more about that experience?
Yeah, I mean, that doesn't come up a lot in the conversations that I'm having nowadays because it literally is ancient history. Like if it was a car, it would be an antique. But I started actually when I was 15 years old. I was a runner on the trading floor on the COMEX, which is commodities exchange where gold, silver, copper was traded. And then eventually went to the NYMEX. But I took the job. I was a kid growing up in New Jersey in the suburbs. And I literally took the job because it was my dad's friend. And I'm like, I'm not going to New York. I don't want to commute to New York City. I'm like, I want to hang out with my friends. And they're like, it pays $5 an hour cash. I'm like, I'm in, right? And so that kind of evolved from there. The first summer, I loved it. I'd never seen anything like it. The energy, just the sheer action and the amounts of money flowing back and forth. I mean, even as at 15, I recognized it really quickly. I became the youngest member of the COMEX at the age of 21. I graduated school, sold my car, leased a seat, financed my account, and just, this was a very kind of social thing where I made relationships when I was clerking as a teenager and summer runner, et cetera, and did every job there. And you just leverage those relationships. And I found myself standing in the pit and making money at 21. And it was just, it was an incredible experience. Little footnote, I did that for about 10 years. Little footnote, the movie Trading Places has a scene at the end, the famous trading scene from the pits. That was actually filmed on a Saturday in the World Trade Center back in the day, in the gold pit. And I happen to have known a lot of the traders that are in that movie, some of whom are no longer with us. But it was every time I see that movie, and when I built my hedge fund, Katana, I made sure that every summer I showed the intern class that movie. I was in a WeWork and they had a theater, as one does, and I would show that movie to show just what it was like back in the day, and every intern was just fascinated with it, right? Because that doesn't exist anymore. And it probably never will exist again, but it was truly just like one of these crazy magical places which stays with you forever, kind of like combat.
It's so incredible to even think about that, because I can't, because I'm so used to going on a computer and looking at Bitcoin, Ethereum, et cetera, all these tokens and whatnot. But you're saying people would buy and sell commodities like to each other, and they would verbally yell the buy, sell, et cetera. Like it's so mind boggling to me.
Well, to everybody on the outside, when you see, like if you saw Trading Places, for example, it's the best example of it. I think if you YouTube Robert Downey in his early years was at the NYMEX and actually said some pretty not nice things about us all, but it was hysterical. But if you watch those pits at the time, it just looks like a bunch of people waving their arms, jumping up and down, screaming at each other. But it was one of the most ordered buy and sell mechanisms that ever existed, and went back to the early days of civilization. And that actually, believe it or not, gave me a real fundamental understanding of how markets work, really from the bottom up, and from there, how trades are cleared. Because there on the exchange, every day you get a sheet in the morning which told you what trades were good and what trades were bad, who didn't know what trade, and you'd have to go to the other side, physically go to the other side, the other person, and say, hey, I know this price on this trade, you know that price. Let's figure out how to remedy this. And you would figure, and that really gave me a really formative base as to how markets work, and specifically in my mind, how technology could change that. And that was the beginning of my first technology firm, which I eventually sold to NYMEX. A gentleman named Vinny Viola was the chairman, and I met Vinny during the NYMEX Comex merger in the early 90s. Vinny, as many people know, is the founder of Virtu, and he was also really, really seminal in my professional development. Uh, Took me under his wing at NYMEX, bought the company, made me the CIO, and the rest is history. Took NYMEX from open outcry to electronic trading. Went to London for 2 years. I became the CEO of NYMEX Europe. Came back, became the EVP of NYMEX, which was the functional equivalent of the COO position. We did an IPO, which was a record at the time, and then did a $9 billion transaction with the CME in your hometown. So I'm very familiar with Chicago as well. And like a whirlwind, worldwide experience like none other.
That's incredible. Wow. Okay. So how was the transition from open outcry to computerization? Because like that must have been a pretty crazy change. And then do you see any analogies towards, or I guess like in the current or potential of crypto where, we think there's going to be lots of on-chain securities and eventually that's kind of like a next level up? Or tell me about that.
Andrew, that's precisely why I'm here. If you look at my career, I have been at the nexus of change in this industry for 25 years. Open outcry to electronic trading to low latency, high frequency trading, data warehouse appliances to big data and cloud computing. And so it's only natural that I made the shift into crypto, because this is in so many ways just like the migration from open outcry to electronic trading. I mean, it is in terms of how the financial industry is going to evolve over the next several years. It is extraordinarily similar to that transition. So look at TradFi right now. That is open outcry trading to crypto is electronic trading. And you're seeing this happen in so many different ways, right? So, tokenization of securities, real world assets. Importantly, there was a deal recently with Canton Networks, and what kind of slipped everybody's, under everybody's radar is an investor in that deal was none other than DTCC, Depository Trust Clearing Corporation, which is the clearing corporation for every equities transaction in the United States. It's a centralized clearinghouse for all equities. And they're investing in a crypto tokenization network. Where do you think this is going? So open outcry to electronic trading back in the day. I learned a lot about how the status quo, and listen carefully because this is kind of what's happening right now, how this, and it's been happening for a decade or almost, how the status quo will put up every barrier and make every excuse to prevent change from happening. However, never ever in the history of technology, and this is also where it's scary in terms of AI, never ever in the history of technology has an exchange or any widget maker said, let me go back and go with the slower, more primitive version of this than the more advanced one if I can. And so that toothpaste is out of the tube. 7 days a week, 24 hours a day. Trading and clearing in crypto, it's the norm. I mean, we don't take any time off. Saturdays you're checking your you're checking your screens, you're checking your portfolio. You want to move money on a Saturday or Sunday, it happens instantly. It's like any other day. Traditional finance still has those barriers up, and people ask why, and it's precisely because of that same sort of open outcry to electronic trading transition. um, First of all, systems in TradFi are still antiquated. uh, Exchanges may have the capability to go 24/7, but having been at the center of that ecosystem at both NYMEX and FINRA, what I can tell you is banks, upstream vendors, downstream vendors, processors, fund admins in TradFi do not have the capability to do a 24/7, 365 processing cycle. And so they are putting up, and they will continue to put up any sort of barrier excuse that they can until finally it's just an inevitability. And generally, the tipping point usually occurs when some large institution, some large customer says they take the plunge, and every one of their customers turns to customers of other institutions and says, if you don't do this, then we're going there.
So in your opinion, why have we not seen because I guess early on, I've been in crypto since 2013, 2017, I was like, oh my gosh, by 2018, 2019 at the latest, every single financial institution will be utilizing blockchain and it'll be the future of markets, et cetera. I was super, super bullish, way off on timing. In your opinion, what has been the biggest blocker in terms of that adoption? I mean, and we just had this new friendly administration enter in November. So that's kind of regulatory issues are lessened. But was that the biggest blocker, or is it more of like hey, we need a profit motive in order to transfer to this new tech?
Yeah, I think the profit motive is there, and I think you hit on it. The biggest blocker has been never ever in the history before this past January have we seen an administration and a regulatory environment that's been friendly to crypto. It just hasn't happened. As a matter of fact, it's been antagonistic for a decade or so. We are early innings. This is a very, very young asset class, even though it started in 2009 and many people have been around for over a decade. We're still young. We're still in early innings. And I'm going to date myself again, but you'll find that I like to quote movies too. So there's a scene in Spies Like Us. I'm dating myself. And there's a scene in Spies Like Us where Chevy Chase is playing a surgeon, and he's trying to fake it. And somebody questions him, and he raises his hand and says, "We mock what we don't understand." And that's kind of haha funny, kind of like what's going on in crypto versus TradFi until now. We have a friendly regulatory environment. We have macroeconomics and a fiscal situation in the United States which is untenable. This is all driving the use case and adoption for crypto, but specifically the driving the forcing function, if you will, is now institutions who are normally risk averse, and the larger the institution, the more risk averse it's going to be. I was at a regulatory organization, about the most risk averse place you ever want to be. And for good reason, right? Because it's all about reputation. So they can't afford a misstep. Well, the big missteps in the financial world are you don't want to be fined by a regulator. You don't want the government coming after you. You don't want to, essentially, you don't want to be the guy going to jail. So now that those hurdles are, for the most part, cleared away, you're seeing and you're starting to see the green shoots of it, right? You're seeing banks start to come around. Everyone's going to have their own stable coin. You've seen the Genius Act. You're going to see clarity. So it's here. It's happening. Still early innings. That's why I'm here, and I'm really excited, as you can probably tell. I'm really excited to be here, to be here and watch this and participate.
Or going back to your early history, when did you first discover crypto, and what got you specifically excited about it? Because I saw at your firm Katana, you were trading traditional assets and crypto. That was, I believe, in like 17, maybe earlier. So you knew about it for quite some time and were actively involved. But at what stage were you deciding, okay, I need to go, I like this so much, I want to go fully in?
Yeah, so it kind of happened for me in stages. So at Katana, we were running primarily a VIX volatility fund. We were pretty large, sometimes up to 10% of VIX futures in a day. Um, that pretty much took up all of my time. And my first foray into crypto, like almost anything, was based on a little bit of greed. And so we're trading on the SIBO. SIBO had their own futures exchange, and within that had their own futures contract, which predated the CME contract, by the way. And when CME came out with their Bitcoin contract, we were asked to be market makers, and we became market makers in both Bitcoin and ETH shortly thereafter. And I did it really, for the money. There was $1,000 arb between the CME and the CFE contract on most days when it first started out, and I'll never forget. And this was the light bulb went off because we had plenty of money up with our clearing firm, blue chip clearing firm. Um, Again, risk averse certainly, but we had a really good credit line, and we could only do 5 contracts at a time. That was it. And no matter who I went to, no matter how high I went up in that organization, um, the answer was just no. We don't understand it. We don't know what this Bitcoin thing is. It's a scam, but it's here, and so we'll allow you to trade it, but 5 at a time. That's it. And so the light bulb went off, and I'm like, there must be something here. And so we continued to make markets on and off. I dabbled a little bit, but nothing really major because I was so involved and invested in VIX. Remember, we traded through, let's see, we traded through the Brexit situation. We traded Volmageddon, which was very good for us. And we traded through the pandemic, which was also quite good for us. But that was all volatility. And then in the middle of the pandemic, I was hunkered down, and I saw Bitcoin was trading I'm like, oh, where's Bitcoin? It's trading $7,800. I decided, okay, I'm going to buy some. I'm like, what's my downside? $7,800. So I'm going to buy some. Why not? And at that point in time, my investors did not want anything to do with crypto. And then I said, these are traditional large fund of funds, and there must be something here. And so I kept on exploring and digging and trying to press, and they just wanted nothing to do with it. And eventually I went out on my own and just started trading crypto, started market making, adapted my software to, I think at the time, 14 different exchanges or so. It was quite frustrating. Went back and forth. And this is where my ins and outs kind of went kind of back and forth, got a little frustrated, went back to TradFi. But then in like late 23, I just had the epiphany. I'm like, there's going to be an election this year. My thesis was that no matter who wins that election, no matter who wins the election, there is going to be a more favorable regulatory environment for crypto, because my thesis was even if the Democrats win the election, Gensler was out because of all the crypto PAC money coming in. So, and the thesis also went so far as to say, okay, but if the Republicans get in, if Trump gets in, then we're off to the races. And I said, well, I've got to make this choice. I said to myself, this is generational. I looked at my kids. They have grown up in a world where they've never not known the internet. Most of them and their friends, nobody carries cash. They're all paying with Venmo or digital. They're very comfortable with a virtual currency, with a virtual experience. And I said, well, this is who's going to be making decisions in 5 or 10 years, like it or not, adapt or die. And then I looked at as I said, the macroeconomic and the fiscal situation here in the States. And the conclusion was, you've got to be in an asset class which is decentralized, fixed supply, really can really take advantage of, basically a gold-like asset storage or store of value situation. And I'm like, I've got to be in. So I made the pivot, and this time I said, I'm gonna I'm going to stay. And I call it my Cortez moment. So when Cortez, the explorer, got to America, or actually Mexico, I think it was, he basically gave the first order that he gave to his men when they came ashore was to go and burn the boats, indicating to them that there was no way back and that you've got to make it work here. And so what I did was I took my software, which was really fast and some of the best in the industry in TradFi, high frequency, and I sold it, which was nice. And that was my Cortez moment of saying, I'm not going back. And that's when I, was reintroduced. I had met Ari and Matthew from Block Tower back in early 2021, about the same time I met the Falcon X guys, Raghu and Austin. And I was reintroduced to Matthew at the time. And we started talking. One thing led to another, and I came on as the co-PM with Ari at Block Tower. And that's when I started my for real 100% all in 45-degree angle in crypto journey.
Amazing. Wow. Okay. So you're at Block Tower. Were you also doing directional there, or was it some other strategy? And then at what stage do you decide, okay, I want to, kind of level up a little bit and go to Monarq and run this directional fund?
Yeah. So no shock. I have a highly technical quantitative background. Towards the end at Katana, we were almost 100% machine learning based. That was before machine learning was called AI. Um, and we were almost 100% at the end, pattern based, pattern recognition, predictive analysis, big data, those types of, that type of analysis. And when I got to Block Tower was a real shift for me of going from high frequency, low latency, arbitrage oriented trading or relative value sort of trading to, as Matthew at the time put it, an asset manager. And so as an asset manager, my time horizon was much different and my risk tolerance had to be adjusted in the context of, look, I'm going to buy something. I've got a view on a month from now or 3 months from now or 6 months from, or even a year from now. And that's my investment horizon. I've got my target price. I've got my falsification price on the downside. And we go from there. Block Tower was a long biased fund. And so in terms of just going outright short, that really wasn't possible. And the investors were very comfortable with the sort of with that sort of exposure. They really, really wanted right tail, that sort of explosive right tail crypto exposure and volatility that crypto brings. And so that took a bit of adjusting. And I put several processes in place, though, in terms of research and implementing things like profit taking, stop loss, time horizon of the investment, just putting some quantification around what we were doing, but not nearly to the level of what we're doing here at Monarq.
Very cool. Okay. So this is kind of a quick tangent here, but I've talked to a lot of managers that were former TradFi, now crypto, and kind of the one recurring theme that keeps popping up is alpha decay, and how in TradFi it's exceptionally difficult to generate alpha on a sustainable basis, especially when you have it's almost like the big players have gobbled up like the majority of alpha, and everyone else is kind of like you can carve out a very small niche, but it's pretty capacity constrained. And meanwhile, crypto is like the opposite. It's like extremely alpha rich and very disorganized on a comparative basis. What are your thoughts on kind of alpha decay comparative to TradFi to crypto?
Sure. That's a great question. So I'm a big fan of history. If you ignore history, you're doomed to repeat it. And our market, when I say our market, crypto is following, I believe we are probably where the US futures market was in about 2003. And what do I mean when I say that? There's still a lot of decentralization. There's not a lot there's very little co-location. So there's very little kind of latency arb advantage that you can really get just due to the decentralized nature and the geographic location of a lot of match engines. And being that a lot of the match engines in crypto are located in the cloud. It's very difficult to figure out how to get really, really close to them. And then some are located in US, some are located in Japan, some are located in Singapore. So there's a natural speed of light type of thing. And I like to say that's a really hard latency arb to get over. And if somebody can figure that out, I've got a job for them. But all joking aside, in TradFi, alpha is super hard to come by because of what I call the race to zero. So high frequency trading has become a race to zero, where in TradFi there are now people are now profiling in single digit nanoseconds, and some are actually in sub nanosecond and picoseconds, right? And the sheer cost to keep up with this in terms of hardware, software, network, programming, FPGA, researchers, it's really not for the faint of heart. And it's really, you must have really, really deep pockets, but not only deep pockets, but a lot of good political connections at the different exchanges and liquidity centers in order to figure out where I need to place my servers, what are the best cages, is latency equalization really latency equalization? Show me the audit. They can't show you the audit, right? And it's kind of, I got to the point when I was doing it to try and really just eke out alpha that way, which is, I came up with a saying, right? The dumbest trades are the most expensive ones to do. What does that mean? If I want to buy and sell something on a latency based arbitrage, right? That's a dumb trade, right? I'm going to buy something here. I'm going to buy something here. I'm going to sell something there, and they're going to be at two different prices, and I can do them nearly instantly. Well, that's a race to zero, where the edge to be able to do that gets faster and faster, and only it's a winner take all game. I found that to be relatively, at the end, unsatisfying, just because it was just, quite frankly, just wasn't any fun anymore. It was a lot of fun in 2014, 2015, 2016, when there was a lot of ARB. So you didn't necessarily have to be first. You could be second or third, and you could still make money in your latency strategies. Fast forward to now, that's not possible. In crypto, I view the opportunity set to carve out alpha as much different and much more sustainable. So, for example, options in crypto, I believe, are still wildly mispriced in a lot of different ways, and provide a really, really good source of alpha for our directional quant fund. In terms of the ability for me to give the fund right tail convexity and protect left tail downside in a relatively inexpensive and risk adjusted way. There's still the ability to transact exchange to exchange at price differentials, which, if you have a good transaction structure, you can still, a transaction fee structure, you can still do that. And that's going to be for a while. Now, will it last forever? Probably not. It's inevitable. Like I said, if you ignore history. So what's going to happen here? I do think that new entrants will be coming into the marketplace. You'll see fee compression on the exchange side, which is good for people like us who trade a lot. But that will be driven primarily from exchange competition for liquidity providers from high frequency. And so then what's the next step there? Co-location. Exchanges putting their and you're starting to see it right now, right? There's LD4 in London, there's NY4 here in the US, there's TK1 in Tokyo. So it's there, it's ready, and it's going to happen. But I don't see it happening for quite some time. And I also think that crypto is so broad and diverse. DeFi, CeFi, RWA, the OTC markets are just absolutely thriving and a great place to transact. It's so this is like this big old vibrant community. It's really um, it's really really refreshing to be able to trade here.
Amazing. Okay, so so many more things I want to go down the rabbit hole there, but I want to talk more about Monarch. Okay, so after Block Tower, you decided to join Monarch. Monarch. What was the kind of the decision there? And then additionally, um, were you going to Monarch to enact the same kind of long biased directional strategy, or was it kind of a different strategy entirely?
No, so Block Tower, as no secret, was sold to Arca, and I really like the guys at Arca. They're a really nice group of people. I just didn't want to continue doing what I was doing at Block Tower. Again, I started to feel a little bit unfulfilled, if you will, kind of not being able to do things like put on some complex option structures, as well as just go short if I wanted to. Um, but at the same time, I mean, it was a wonderful experience. I wouldn't trade it for anything in the world. I met some extraordinarily bright and talented people there. I'm still friends with most of them today, and we're a pretty tight knit group even today. That being said, like I said, I've always been friends with the Falcon X group, very very long time, and I respect them very, very highly and hold them really, really, really close to my heart. And in deciding what I wanted to do, I consulted with them, and they said, "Oh, you've got to meet Shalang." and so this was Shalang Tang, who's our managing partner, and so they introduced Shalang and I, and there was a lot of commonality of thought, of background, of experience, and I really kind of took to the team when I met the team here at Monarch. At the time, it was called M&NC. We rebranded as Monarch in June. And when I met the team, it was just like one of those natural things. I mean, one person here is smarter and more accomplished than the next. I feel honored and privileged to be in the room with all of these people, and it's really just an energizing sort of place to be. I can't explain it other than like I feel like I'm part like in a hedge fund, part in like a in a West Coast Silicon Valley startup, right? Where there's just, it's just a relentless focus on driving returns and improving process and improving what we're doing. And at the end of the day, again, I feel very early here. I feel like the trajectory is just wide open to the right. And yeah, I mean, so far it's been a really, really wonderful experience.
It's amazing. Okay, so on the strategy side, like very few people from, I mean, maybe I don't know them, but I feel like from talking to lots of folks and knowing lots of managers, I don't know too many folks that are doing directional that's quantitative directional. It's more so directional as in like kind of more fundamental driven in some sense. So tell me more about your strategy, whatever you can reveal.
Yeah, I mean, what I can reveal and what I can't reveal. So what I can reveal is this. We call our strategy a systematic long short with discretionary overlay. Really long, kind of technical description, I know. What I'm looking to do in directional is really not done, at least on a large scale in crypto. And I did some research. So a stat from 10x research that's out there, easy to find, is if you bought Bitcoin in 2017 and held it till now, you're up about 565%. If you invested in the average crypto fund in 2017, you're up 211%. So you don't even have to do a lot of explaining after that. The underperformance of crypto funds has been more than 50% of the actual return of what I consider to be the index, which is Bitcoin. And so I thought about that, and I said, well, why is that? Why is that happening? A, and B, then no wonder it's really difficult for directional funds to raise capital. And that's because of the nature of how these funds have been run in the past. In the past cycles, it's been okay. to buy, let's call it 50 tokens, and about 40 of them you'd make money in. No matter which ones you bought, 40 of them you make money in, and you'd have like a 300% return year. And the only problem was that the next year you'd be down 80%. Actual numbers, by the way. And that just doesn't kind of equate to what I'm thinking in the context of how the market is maturing, the new players that are coming into the space as it matures with a friendly regulatory environment that we spoke about before. You're going to see larger institutions, endowments, family offices, sovereign wealth funds want to have their capital managed, and they want to have it managed professionally. And so when you think about professional capital management, who do you think about? You think about Bridgewater, Point 72, Millennium, Brevin Howard. And they offer what I call an institutional style of return stream, which is they pick a benchmark, you capture 80% of the upside, and you try and limit yourself to 20% of the downside. And over time, that return stream will generate a compounding effect. So over 5 years, 10 years, you're beating your benchmark, unless your benchmark is going up 300% every year, which, okay, if that's the case, then no one's going to beat it. And so then I said, okay, so how do you do that? Well, first you need better asset selection. You need a really consistent way of figuring out when to enter and exit trades. You need a really technical way of how to risk manage, and you need to use leverage in an appropriate way. And so all of these things already exist in our market neutral fund. Our market neutral fund's been around for almost a decade. It's recognized as one of the preeminent market neutral funds in the space. The problem with market neutral generally is it's capacity constrained. ARBs can only take so much capital before you start diluting returns and start squeezing spreads. And we can go down that rabbit hole if you want to, but I won't bore you. And so this is why Shiliang and I are super excited about the prospect of the directional fund, that we're taking a lot of the methodology and the technology that's already existing, which is why I don't have to write technology, by the way. Thank you, Boris. It already exists here at MNNC, and I'm working with Boris Ayutin, who's the CIO of our market neutral fund, and I'm working with Boris to essentially publish those signals internally, so that we can take advantage of them from a directional standpoint. So now we have a really scientific way of doing asset selection, and we can put a lot of machine learning and AI around that process. And we can do it pretty easily, and there's not a lot of execution risk in terms of building the technology. We have a really good way of figuring out, projecting what our target prices are, what our stop loss prices are, what our time horizon is. And so that's where the quantitative piece starts to come in. We've also built some technology around options and option selection. So it's not like I'm going to say, hey, I want to buy the 140,000 calls in Bitcoin options because they look cheap. We'll run a model. It will spit out for me the best possible combinations of every permutation of every option that's available for the criteria that I put in, and I can then select that strategy. To make the fund, to basically give the fund convexity exposure. And so you start putting all of this together and you start getting very consistent results. And that's actually showing already since I've been here. Just in terms of how we think about the discretionary piece of it, between Shiliang, myself, other principals, we have a pretty decent track record and amount of years of experience and scars to prove it. And so in things like price target, we may cut our price target short if from a discretionary basis, we kind of feel the market is feeling toppy. And I know that's really cringy to say for a quantitative fund. But there are also indicators And trade indicators, for example, a volatility event occurs, an event occurs in the marketplace that you might not pick up with a quantitative method, but you know from experience that this is something that's going to lead to some price activity or volatility. And hey, maybe I might want to de-risk a piece of this position. It's actually happened recently to us. Um, one of our favorite positions recently was to be long Solana against some other tokens where we're short. And we've had a nice run the past few days based on some of the DAT flow or anticipated DAT flow that we're seeing. We've had a nice run in Solana. We started to breach some of the concentration levels that I'd set for directional fund just from the appreciation of our Solana holdings. And I decided from a discretionary basis, even though we've not hit our target price, to de-risk the position slightly, take about a quarter of the position off, just from I want to de-risk the position slightly. And I hope that we're having the conversation later that these are the worst sales that I ever made.
You actually, my next question was going to be around the discretionary overlay, because there's so much information that can be unpacked there, but you explained it very well. And I also feel like within crypto, if you go full quant, if you go 100% quant, I always say, like, in crypto, the edge case is the norm. Whatever, like, you don't think is going to happen, like, will probably happen because it's crypto. And so if you go 100% quant, I feel like that could just potentially, at some point in time lead to some disaster because Trump tweets something, or who knows what.
Yeah, look, great point, right? I was just going to bring up the tweets, right? So, if it's on Twitter, it must be true. And yeah, but if you're running a quant model, if you're running a quant model based on Twitter and you're calculating sentiment, for example, off of Twitter, and your model sees something on Twitter, a post on Twitter, it's going to think it's true, and it might not be true, actually, just in case people are doubting that. And so that's where the discretionary piece comes in. If you, I think we're a long ways away from having like AI models that can do the job of a discretionary trader right now.
All right, Sam. So can you tell me what are the biggest inefficiencies within the directional strategy that people are not aware of, or maybe tools that people aren't utilizing? Like you mentioned options and whatnot. And I know the options market in crypto are still kind of pretty early. So yeah, I mean, don't leak too much alpha here, but what are some areas that you think managers are not paying enough attention to when it comes to directional investing in crypto?
A couple of things. I first say asset selection. A lot of asset selection in directional right now, and this is based on experience plus belief, is really kind of going back to Twitter based on, hey, I just saw something on Twitter and I did a little bit of research, and I'm kind of backing it up with a few screenshots, and that's how I'm going to do my asset selection. There's no real quantitative basis to that. Now, that's okay for something where you're looking at a new token that doesn't have a lot of data, and you're just going to kind of take a punt, if you will. But in terms of asset selection, I think that a lot of process is flawed. And I won't go much deeper than that into like some secret sauce, et cetera. But I also think at the end of the day, from a directional standpoint, one of the hardest things to do is to take your profits in crypto. It is a hyper volatile asset class that is highly susceptible and influenced by social media, as well as your own greed and FOMO. And so we as human beings will tend to reprice things. So if I have something that goes from, like, let's call it 3 to 8, and my target price was 8, and it's now trading like 825, 850, you might be really tempted to like not sell it and hang on. And I think ultimately repricing things or re-underwriting a token and its target price, I think, are a mistake. Because at the end of the day, you came up with a thesis to get into and underwrite a particular position. And part of that thesis was your target, and it was based on some level, I'm hoping, of quantitative analysis and you got to your target price, and you need to have the discipline, just like if you got to your stop loss price, you need to have the discipline to exit the position. Because what starts to happen is, you might be right if you reprice this and you say, hey, instead of 8, it's going to 20, and it does go to 20, and you look like a hero. But I think if your analysis, if you're a good analyst, and you have good quantitative methods behind it, and you have some level of accuracy that you can measure as to what those predictions are and are going to be, what starts to happen is, when you start dancing around those exit points, and you're right, it's kind of like you're being rewarded for bad behavior, and eventually that catches up to you. I think in machine learning we call that a false positive. And so that really, you shouldn't even count as a positive result at that point. So like, the discipline to get out is as important as your asset selection. And I think it was JD Rockefeller said that never go broke taking a profit, right? So you live to fight another day. You take your profits. You manage your book. And I think that's really what's missing from most directional funds toolboxes these days.
Yeah, and I would love to double click on that exit point, because it's so incredibly important, and I feel like it's not talked about enough. So, could you walk me through a very basic fake example of how someone would come to a conclusion that, hey, this asset is at 10, I think it can go to 20. What kind of research or quantitative analysis needs to be done in order to come to that 20 exit conclusion?
Right. So let's just say you research. I don't know. Let's take Hyperliquid. It's a great analogy, right? So Hyperliquid is trading something like 20 a few months ago, and just based on fundamental analysis, go onto the site DeFi Llama, go to anywhere you want and look at the fees that they're taking in, the revenue or their market share in terms of where they are versus Binance. You can from any number of different indicators come up pretty easily that on a relative value basis, and this was right around the Circle IPO too, right? And from a relative value basis, it was cheap compared to Circle. Even if you said, okay, fine, I'm going to give some sort of discount for private market valuation. And so when I first started underwriting Hype, and this was last December where I was first allowed to buy it, and we started buying it at like $9, and my target price was 50. My target price was 50, just based on where they were at the time, and how they were growing, and what those projections were going to be. And every time that it dipped, I recommended leaning into it and buying it. And I really didn't have a downside case, because of my downside case in Hype was that it goes to zero. Really, it was really that high of a conviction bet from my standpoint, just based on those fundamentals. The falsifying factor, if Hype goes to zero, would have to be some sort of collapse in the systematically in Hype, whether it was a hack, or whether it was operational failure, or some sort of financial risk management failure. But on the fundamentals, it was one of the strongest things I'd ever seen. And I was pounding the table on that, and everybody back in the day remembers me for doing that. And recently, we hit $50. Actually, yesterday we hit $50, and I exited most of our position. I didn't exit the entire position. I didn't reprice it, but I exited most of the position to see what the price action was going to be around 50. Now that's a discretionary overlay there, right? I probably should have exited the entire position, because that was my target price. I probably will again if it pops up. It's trading 47 now. I'm really not too worried about the residual position that I do have. It's kind of like playing with house money there, so I'm okay on a risk reward basis. But at the end of the day, you get to 50, and you start to think about things like, wow, it could really go to 100. Wait, it's at 50. It could really go to 100. Well, if I get rid of it here and it goes to 100, everybody else is going to be long and they're going to be talking about how it went to 100 and I'm not going to have it. And you have to kind of get over that. And to an extent, look, we're human beings. It's really, really difficult to do that. It's really difficult to have that, that discipline. And so a false positive would be if it does go to 100 and then I sell the remaining like 2% of my position, and it goes to 100, well, that's a false positive because now I got rewarded for bad behavior. So, it even happens to those of us who practice it. And at the end of the day, we're all guilty of this, right? Like you can't show me a manager out there that hasn't done this. A better example is recently Bitcoin hits 124, right? So Bitcoin hit 124. We had a decent amount of convexity on. Everybody starts talking about the 140 calls, the 150 calls. I started looking at the 110 puts. And at the same time, our target was 126 to 130. I used our discretionary overlay and I cut our convexity in half at about 123 or so, 122 to 123. I cut our convexity in half in BTC to see, okay, we're looking toppy here. I'm seeing sellers come in. We're watching some wallet movements that really don't like play out to the bull case. And so using those quantitative metrics, we decided, okay, fine, I'm going to cut some convexity here. At the same time, while everybody is looking, and it's human nature to say, okay, now we're at 124. I'm not going to sell anything because it's going to 150. I'm looking at 110 because I'm a steward of our investors' assets. And as such, I'm looking to protect on the downside. And if that's a drag on our returns, then so be it. I'm okay with that. But I hope to have to explain that if we're trading 150 or 180.
Awesome. Wow. Thank you. I mean, those are stellar examples. All right. So the portfolio, are you operating a very, maybe there's only 5 positions in the entire portfolio at one time, or is it 50 positions and then
Yeah, it's not 50 and it's not 5. But I limit myself to top 30 market cap tokens plus special situations. So special situations are things like DATs or things like the pump ICO, for example, and different situations that we see potentially coming up that kind of fit Directional's mandate. Sanat Rao, who was also a Block Tower previously, he's the CIO of our Bitcoin fund and also a DeFi expert. And so he may bring from time to time some directional plays for us in DeFi that we'll be interested in. I call that a special situation. And so on the top 30 tokens right now, I could tell you we have, and I will look in my portfolio management system that we built. And I will tell you that we have, probably 14 positions right now, of which 6 positions probably make up about 80% of the portfolio.
Very cool. Okay.
No one position more than 30%, no 3 positions more than 70.
Yeah. So managing risk, there's a multitude of different ways to manage risk in crypto. Traditionally, it's just meant like, what's your exposure to the tokens? Because like shorting was very hard. And then after that, it was more so like how many assets are you holding on exchanges and whatnot? How are you managing risk in this portfolio?
So we look at risk in 2 different ways. We look at length, net length, which is longs minus shorts. And so that could also be a negative number if we're short. And then we look at gross exposure. So we take the absolute value of the exposure. And that gives us a really good idea of how much of our capital we're really using, how much leverage we're employing. I've been up to 108% in this past move, and I've been down to 30%. So in terms of net length, and we measure risk accordingly. And going back to the quantitative methodology, the most important piece for us is every position from an entry and exit standpoint is quantified. So you have your exit point, you have your falsification or stop loss point, and you have your time horizon. I call that a triple barrier, which is a machine learning.
How infrastructure heavy are the operations of your fund? In terms of like data gathering, and in terms of, you mentioned there's a custom build portfolio tool that you're using. Like, if someone wanted to spin that up, or if if someone wanted to spin that up, or kind of be at your level, in terms of time, effort, capital, what would they need in order to be at Sam's level in terms of your operations?
To be at Sam's level, it would be a lot because Sam is supported by a stellar team here at Monarq that I had the really, really good fortune of being able to step into. And so we've got a technology base that's been around for nearly a decade, a lot of it. We have internal data gathering tools. As a matter of fact, we're building our own LLM at the moment. So it's a pretty sophisticated operation, and operationally, it's not too heavy because of this. Again, because of how it's been implemented, it's pretty elegant. As a matter of fact, from somebody who's seen technology at almost every different level in the industry, it's a really elegant implementation. So to spin up to get to where we are right now would be pretty difficult. To start your own fund and have the basics of data ingestion, data cleaning, some machine learning methodology, some basic portfolio management tools, etc. The great thing about crypto is it's all free. It's all free. You can, pay for data services, and we do have a couple of different external data collators and providers that we do use, just because it's just cost efficient for us. But if you wanted to start from scratch, all of the data is out there for free. I mean, that's another major difference between crypto and TradFi. Anybody can start at any time. They don't need special connectivity. They really don't need that any money, if it that much money, I should say, to be able to do it. And market data, for example, is free. Market data is not free in TradFi. As a matter of fact, I was probably one of the people who made it not free. So blame me. But at the end of the day, it's a pretty democratized, flat platform, crypto. And it's really, going back to the days of the pits that we were talking about, right? It's a meritocracy.
So if you could wave a magic wand and create one piece of infrastructure, or like some service provider increase their capabilities, or just make a new service provider that doesn't exist yet, what is that missing piece of operational operational needs that you'd want to exist?
That's a great question. There's so many. I would probably say some sort of uniform standard around market data would be phenomenal. The maintenance, like I said before, it's pretty easy to go and get started, but every exchange has a different API, et cetera. Now there are tools out there in Python, for example. There's a good tool called CCXT, which is a free library that kind of normalizes this stuff. But it's also it's kind of heavy on latency. So if you're looking for low latency, not too many people, for example, have multicast. Not too many exchanges have multicast data feeds. I think Deribit's the only one, and I think that's a little bit that's a little bit lacking. So if I were to wave my magic wand, that would be one of them. Another magic wand would be the ability to kind of bridge protocols relatively seamlessly without having to, kind of go through the brain damage of figuring out how to wrap and unwrap and move, etc. But I do think that, that's why there's opportunity.
All right, I want to move on to a few big picture items. What are your thoughts on DATs? Because I see some people say they're amazing, incredible tools to get institutional investors easy exposure. On the other hand, I see folks saying, "Oh, it's going to lead to the downfall of the next crash is going to be caused by DATs." So what is your take?
Both could be true. So we're involved in a tremendous amount of the DAT flow. We see a lot of, partially due to our experience between Shillang and me, our experience in TradFi and relationships there. Partly also because of our relationship with FalconX, and we've been selected to manage some of the digital asset treasury vehicle treasuries, and that's been a really interesting piece of side business for us. I think that DATs as a whole are a really good invention or implementation or evolution of crypto. And here's why. If you're an endowment, for example, you probably want some crypto exposure. Bitcoin, Ethereum are the best performing assets in the last year over year. So you probably want access to that environment. And right now, the only thing you could really buy, or prior to DATS, the only thing you could really buy would be IBIT or ETH or the ETFs, any of the ETFs. Take your pick. And that was the only way that you can have access. So I view DATS as broadening the ability for traditional players who either don't have the mandate to trade crypto directly and or don't want the complexity of crypto rails and have to implement an entire crypto custody, et cetera, go through all of the machinations to have a crypto operation. So you're broadening the appeal and making it easier for anybody to trade crypto, and the digital asset treasury vehicles offer this other level beyond an ETF, which would be in some cases yield generation, in other cases a basket of X, Y, and Z that equate to something that's desirable for some people. So ultimately, I think it's a great development in the financial markets. There is a bit of a mania going on, as we all know, and I think that the MNAV premiums, as we know them today, I mean, we see them coming down. I said this about a month and a half ago that they're not sustainable, and they're still coming down. The reality is that I think people should not be investing in DATs for an MNAV. I think they should be investing in DATs for the sake of the components of the DAT, right? And to that end, the way that this ends badly is some of the quality of product that we're seeing coming onto the market. And we internally at Monarq, we developed a quantitative model to be able to rank and score each deal. And we give it a score, and it's been holding pretty close to our scores, the performance of these things. And it's actually not really difficult to do. It's not really difficult to figure out. But the quality of what we see coming into the market has certainly declined. Some are doing it really, really well. Bitminer Tom Lee, I think he wrote if you're out there and you're going to do a DAT, read the Tom Lee playbook because he did it perfectly. They did it well. Reserve One, as you know, we're involved with them. Again, stellar team, great execution, phenomenal structure. That's another one that's going to succeed, right? Some of the other ones, maybe not so much. And you really have to look at things like, well, if they're issuing a convert, at what point are they going to be forced to sell assets to pay to do their debt service, right? And those are the ones that are a little bit troubling. And of course, then you have this kind of run-on effect that could happen where the lower quality DATs have to come out and sell to pay down some of their debt, which then snowballs into this negative feedback cycle where they sell to pay debt, which drives the price of the token lower, which then makes others sell to pay back debt, which drives the token lower, et cetera, et cetera, et cetera, right? But these things happen in TradFi as well, and it's part of the market cycle. And we'll know it when we see it, and we'll act accordingly.
How will your job change once this future that we think is happening over the next few years with on-chain securities and tokenization of assets? Will your job change? Like, will you be trading I don't know, some previously illiquid real estate asset that it hasn't been tokenized yet, or will there be no major changes in your opinion?
No, there's one thing that's always constant in this industry is change, right? So yeah, my job will change, your job will change, everyone's job is going to change, and I think ultimately the messages will all be fine, right? Quality rises to the top, and I've been quoted as saying, again, going back to the trading floor, it's kind of like this genesis for me. First day on the trading floor, a guy told me traders always find a way to build a better mousetrap. So yeah, I mean, markets will evolve. My job will change. We'll be trading different things. we'll figure out how to trade them. We'll figure out how to extract alpha and deliver value to our LPs. It's kind of that simple. I can't really predict. Is it going to be real estate tokens? Is it going to be equities? I mean, I do think it's going to be equities, but to be TBD.
Amazing. All right, Sam, last question before the closing questions. Where is Sam 10 years from now?
I'm still going to be doing this. I love what I do. I'm not retired yet, and I have no intention on retiring. Kind of adapt or die mentality. I love the action. I really like being. This marketplace is super energizing. Like nothing I've seen again since the trading floor, since the old NYMEX days. And I'm enjoying it thoroughly. I don't see how that changes. Yeah, I mean, I hope to be sitting in this seat 10 years from now, and I hope to be talking to you from a multi-billion-dollar Monarq empire.
Love it. All right, Sam, it is time for the closing questions. You're going to love this first one. Okay. 3 years from now, what is your Bitcoin price target?
3 years from now, my Bitcoin price target. Wow. Gee, that's not a standard question at all. Let's see. 3 years from now, I'd probably be amongst the consensus of saying between 400 to 500.
Oh, wow. I like that. That sounds great to me. Yeah. All right. What is the best advice you've ever received?
So this is going to sound really harsh, but it was Vinny Viola on my first day at NYMEX. He puts his arm around me and says, "You're only going to get this chance one time. Fire everybody." And that was, and wow, that sounds really harsh. I'm sure some people will be saying, "Oh my God, guy's crazy," but the reality is that I was entering into an organization that was really severely dysfunctional. Had not delivered any technology in over a decade, wastes of money, a lot of cronyism going on. And the advice was clean house, right? And so I take that going forward as saying, never be afraid to stop, and don't go down that rabbit hole. If you're going in the wrong direction, recognize it, take that loss, go back and start again if you have to.
I love that. It's harsh from one perspective. On the other perspective, it's like the smart, right thing to do in some sense, So very cool. All right. How has being an entrepreneur and fund manager changed you as a person?
Oh, it is who I am. It's always been who I am, right? So I might not have always been a fund manager, but I've certainly always been an entrepreneur. Even when I was at FINRA, for example, which is a big reason why ultimately I decided to leave FINRA, is because I have very strong entrepreneurial urges and tendencies, and so the fund manager part kind of evolved out of all of that, and it really evolved out of me being a trader, going into electronic trading, and really focusing on ARBs, and then evolving from the race to zero to machine learning and more sort of managing risk. And then Block Tower was seminal for me. It just was. Like I said, everybody says, "Oh, they sold the firm," and I really enjoyed the experience overall. There are ups and downs to everything, but it was seminal for me in terms of really understanding how to be an asset manager and to be a fund manager.
That's great. All right. What is your most contrarian opinion that you have on the crypto space right now?
Most contrarian opinion that I have on the crypto space. Okay. I suppose it's that I still think Bitcoin in this run is going to make new all-time highs. And I said that last week. I think I was in a CoinDesk article. And I said, Powell's comments cleared the way for possibility of a rate cut next month, and clear the way for ETH to go 5,000 plus. We almost went there. It was 49.50, and for new all-time highs in Bitcoin. So Bitcoin seems to be this year's Ethereum right now. But I do, all kidding aside, if you zoom out, I use this term internally here at Monarq a lot, because as an asset manager, rather than as a trader, if you zoom out and have a longer term lens and you look at performance year over year, go 1 year back today, August of 2024 to today, Ethereum has just surpassed Bitcoin in terms of returns year over year. It's taken all this time for it to make a new all-time high and to get to the point of basically, within a couple of percentage points of where Bitcoin is year over year. And so we're still in a really good spot in terms of the bull run. I do think, as we used to score it at Block Tower, we are in the top of the ninth here. We're starting to see a little green shoots of potential mania happening. I'd be watching things like funding rates, for example, to see where those excesses pop up. But contrarian, a lot of people are kind of down right now on Bitcoin, saying, "Oh, Bitcoin's had its run. It made it high at 124. It's had this really big pullback, and it really looks terrible." But on a longer term basis, not so much. So I still think there's room left.
Amazing. All right, last question. Is there a piece of content, whether it be like a book, a blog, a movie, that had a major impact on your life?
Ooh, besides trading places?
Yeah, besides.
Yeah, I mean, I think Atlas Shrugged by Ayn Rand.
Why that?
I'm not trying to be political. I think just in the context of of free markets.
Very cool.
Free markets and the power of free markets. And I guess I'm putting my money where my mouth is.
Love it. Sam, man, this has been incredible. Thank you so much. Where can people learn more about yourself and learn more about Monarq?
Sure. So I'm on LinkedIn/Sam Gaer, SAMGAER. Monarq, our website is Monarq, MONARQ -AM.com.
Amazing. Thank you, Sam.
Thank you, Andrew.